A few of the themes I've been talking about on this channel related to solar energy really came to a head yesterday when SolarEdge announced their earnings for the fourth quarter of 2023. Results were worse than expected, guidance was worse than expected, and SolarEdge really seems to be in a much worse position than its most direct competitor, and that is Enphase Energy. So as we see a lot of these companies like Enphase, like SunPower, we'll hear from Sunrun actually after the market closes, before this video is out, but those companies seem to be saying, hey, the market is going to turn around relatively soon. Europe is down, California is down because of interest rates, because of policy changes, but the rest of the US is pretty solid. And so in the back half of 2024, conditions for the solar market and the residential solar market are going to get significantly better. SolarEdge, on the other hand, sees conditions getting worse. And there's some real red flags for this company. I've brought up some of these before, like negative gross margins, like revenue dropping more than some of their competitors. And now they're not seeing the recovery that some of these other companies are. So I think this is a real concern for SolarEdge specifically. There are market dynamics that the company can't get around, but it seems like those market challenges are really already priced into a lot of these stocks. What isn't priced in is the companies that are going to start falling behind in this. Always happens in the solar industry. You get one competitor who starts to take more and more market share. They see the market as growing. Their competitor who they're taking share from starts to decline. And that's what I worry about for SolarEdge, is that we're seeing that decline in motion right now. So that's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's dig right into the numbers. And I'm going to show a lot of these from the presentation because it's nice to see graphically exactly what the trends are for the business. This is a look at revenue, and on the left you have the annual revenue. That doesn't look too bad. 23.1% compound annual growth rate between 2021 and 2023. That seems great, but look at these quarterly numbers over the last 5 quarters. You can see that $991 million in Q2 2023 just dropped off a cliff, down about 2/3 to $315.8 million in the fourth quarter of 2023. And the problem is that management doesn't see a lot of recovery in the near future. So remember these numbers: almost $1 billion in revenue in Q2, $315.8 million in Q4. Guidance for the first quarter of 2024 is expected to be $175 to $215 million. That means that between Q2 2023 and Q1 2024, revenue is going to drop potentially 80%. That is just an astounding decline in SolarEdge's business. On top of that, they're expecting non-GAAP gross margins to be -3% to +1%. So basically break even on a gross margin perspective. Operating expenses are going to be $122 to $130 million. So that means their losses are going to be somewhere around $130 million for the quarter. And the reason this is so concerning is because Enphase Energy is looking much, much better than this. This is their guidance in the most recent quarter. So this is for the same first quarter of 2024. Revenue is expected to be $260 to $300 million. And non-GAAP gross margin, even if you pull out tax credits, this IRA benefit, is going to be 40 to 43%. So margins are going to be sharply higher at Enphase than they are at SolarEdge. This is always an indicator of the health of a business. How much demand does a company have for their products? Do they have any pricing power? Are their costs under control? And it looks right now like the answer for Enphase is yes, and the answer for SolarEdge is absolutely not. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. I want to go through a few of these trends, and I'm going to start with gross margins. You can see that on a quarterly basis, gross margins have been in sharp decline. This is on the left is GAAP, and on the right is non-GAAP. Even on a non-GAAP basis, we're looking at a gross margin of just 3.3%. From operating margin perspective, you see things are now negative. So this is operating income by quarter. Non-GAAP basis, negative $52.5 million in the most recent quarter. And like I mentioned, that's probably going to be even worse in the first quarter of 2024. Then you get down to the thing that I think is ultimately the most concerning for SolarEdge, and that is that the balance sheet went from a just incredible strength in Q4 2022, $1.7 billion worth of cash, just $600 million worth of debt. So you have a net cash balance of over $1 billion. Inventory, reasonable at $729 million. Relatively low capital expenditures and cash flow from the business. Okay, now go to the fourth quarter, and this net cash balance is down about $400 million from a year ago because they're burning cash in the business. Inventory has exploded, and cash from operations are negative $140 million in the most recent quarter. This is just not a great position to be in for SolarEdge. The reason inventory is such a concern is if you have inventory as a company that makes products, ultimately you have to move that inventory. So what are you going to do if you have a bunch of inventory sitting on the balance sheet? Are you going to discount it? Are you just going to hold it and cut down on your production? Hopefully demand picks up in the future, which it doesn't seem like is happening for solar companies right now. Inventory is a sign that you have a mismatch between how much you're producing and how much you're actually selling. That may indicate that your pricing is actually too high and you actually need to lower those prices. This is something that we've seen in the auto industry for a very long time. Once demand starts to go down, inventory starts building up, you start to get a bunch of discounts, company starts losing money. It's just this downward spiral. And this is what it appears SolarEdge is in right now. It's just in a downward spiral from an operating perspective. And they didn't cut costs fast enough or deep enough when conditions got bad in the middle of 2023. And that's what I think we're really starting to see the impact of that. But the most worrying thing is that they're not seeing a recovery in the market, in part because they have too much inventory in the balance sheet. So they need to move that through the system. And then they need to let the market get back to growth. That may not happen until the back end of 2024. If that's the case, they're going to burn money over the next couple of quarters. That balance sheet continues to get worse. The inventory on the balance sheet continues to get older because right now inventory of $1.4 billion and revenue of only about $200 million means you have well over a year's worth of inventory. These are just terrible challenges for SolarEdge and shows that they're in just a much worse position than Enphase Energy right now. We'll see what some of the reports from some of the other installers look like, but SunPower was the first to report. They have their own challenges, but from a demand perspective, it does appear that they're going to see demand increase starting kind of in the later half of 2024, maybe into the second quarter, but those bookings are really starting to pick up. And so they're starting to see the end of the downturn related to net metering 3.0 in California and some of the drops in demand in Europe. But SolarEdge doesn't see that yet, and they're not going to for a while. And these problems that I've talked about are just exacerbating things. Still have a decent balance sheet with $600 and some million worth of cash, but they have a lot of things to figure out. And if you're having a basically break-even gross margin, that's just not a good sign for a product company. So for now, SolarEdge is a company that I'm just staying away from an investment perspective. I don't see a lot of light at the end of the tunnel, at least not yet. They need a lot of operational improvement. And it's possible that the market is just moving away from their products. They've been focused on power optimizers and string inverters for years. That's really what they were built on. Had a lot of tailwinds in that market. They really grew ahead of microinverters, but now it's very possible that the market is just moving to microinverters. That's what Enphase Energy is making. There's been arguments between the two for a long time from a technical perspective, which one is actually more efficient, but it appears, at least right now, the microinverters are winning out, and that's not what SolarEdge does. So a lot of soul searching that probably needs to happen. The stock is down, like I said, today, and I wouldn't be surprised if it continues declining given the relative weakness in the market for SolarEdge compared to a lot of the other companies in the residential solar industry. But what did you take away from the results? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.